I'm Sebastian St. James. Let's say you're going to get rich and you're going to use the Nasdaq-100 to get you there. Here is the S&P 500, which is in purple, versus the Nasdaq, which is in dark blue. And this is over the last 6 months, and we can see they're going, and dark blue is up the top, and no, it is purple that wins, which is the S&P 500. Oops, it seems the S&P 500 is the winner over the last 6 months, but let's go back further. Over the 1 year, it is purple up the top, and it is, purple up the top, it wins. 2 for the S&P 500. The Nasdaq's not looking very good. Is tech over? Is at the end? With Facebook dropping down, do we get out of the Nasdaq-100 and go to IVV, for example, the S&P 500? If I go back 2 years, well, they're traveling along together, and then purple is breaking out. Oh, purple wins again. That is 3 for the S&P 500, none for the Nasdaq-100. What's gone wrong with it? If we go back 5 years, we notice, dark blue's on top. That's the Nasdaq-100. Dark blue's on top. And it is, dark blue wins. That is the Nasdaq-100. So there you go. You only have to go back 5 years and the Nasdaq clearly wins. But anything can happen over a year or two. We want to have a look at a longer history. Why not, if we want to compare the S&P 500 and the Nasdaq to see which is the better investment, let's look at the entire history of both and be sure that we're making the right decision. That way, the little tech wreck that we've had now, we'll see that in context and see that in fact the Nasdaq-100 is over with, or whether it's just a tiny little blip down. The question is, when did the Nasdaq-100 start? How far do I have to go back? Well, the Nasdaq-100 was launched on the January 31, 1985 by the Nasdaq, strangely enough. It created 2 indices, the Nasdaq-100, which is the one we're talking about in this video, which consists of industrial, technology, retail, telecommunications, biotechnology, healthcare, transportation, media, and service companies. And the Nasdaq Financial 100, whose name you should never mention. It doesn't do as well, but it does exist. The composite has both of them in. Right, that's a Nasdaq. Now, how long has the S&P 500 been for? As long or longer? Longer. So on Monday, March 4, 1957, the index was expanded to the current 500 companies and was renamed the S&P 500 Stock Composite Index. Good, we've got all the information we need. We have our 2 dates. The Nasdaq-100 created in 1985, the S&P 500 created in 1957. If we're going to compare them from the very beginning, clearly that's going to be January the 31st at 1985. And there it is. That's zoomed in of the date range. We're literally going to see the entire Nasdaq versus the S&P 500 right from the very day that the index was created. And they're traveling along and Nasdaq jumps up. You notice that? And then crashes again. How disappointing. But it is out in front and clearly out in front. And whoa, it goes up many, many times. Shoots to the roof. And now you see, just over the last few years, it has dived and dived heavily. But you can see it is an order of magnitude above the S&P 500, and therefore it is clearly the winner. Let's zoom in. Over the entire history of the Nasdaq-100, 10,301% versus the S&P 500's 2,044%. 2,000 versus 10,000% return. The choice is yours. Do I know for sure that the Nasdaq is actually going to beat the S&P 500 from here on in? Well, of course I don't know, but that's what the history is. Am I going to bet against all those decades of history? Well, not me personally, but the choice is yours. So the Nasdaq-100, as of the date of this recording, has been around for 13,822 days, if you're counting, which is 37.84257 years. So if I was to put $10,000 in on that date back in 1985 and leave it in there, do absolutely nothing with that $10,000, then today, on this very day, the Nasdaq-100 would have returned $1,030,156 versus the S&P 500. Well, it's only really 1/5 of a million, isn't it? That's the difference between the 2 indices. One is very aggressive. The S&P 500 is a smoother. Well, as far as shares go up and down. They fluctuate a lot. But relative to the Nasdaq S&P 500, well, it contains 500 shares. If for no other reason than that, it's going to give you a slightly smoother ride. 13,822 days. What's that in years, months, and days? Well, that breaks down to 37 years, 10 months, and 4 days. I'm going to need that figure for my next calculation. Let's convert the return of the S&P 500 and the Nasdaq-100 into CAGR. CAGR stands for compound annual growth rate. So I pop in the $10,000 that we started with, the $1 million I ended up with, and this is why I needed that breakdown. 37 years, 10 months and 4 days, it gives me a CAGR of 13.03%. Do the same with the S&P 500 and we get 8.3%. Okay, two things I'm noticing there. 13% versus 8.3, a massive difference, absolutely huge, and a difference that is worth pursuing. The second question is, I thought the S&P 500 was closer to the 10% mark. Well, yes, it is, because this is purely based on the graph. I have not included dividends, and I've not included dividends in either, and the dividend rate would be roughly the same. There it is, the compound annual growth rate, excluding dividends, between those two dates is 13.03 and 8.3. Our conclusions are the Nasdaq-100 is a very high rate of return. That's incredible. But it's very volatile as well. The S&P 500 has a high rate of return and it is volatile. It's exactly the same without the fairies. This is June. June hates losses, right? Don't we all, June? Therefore, she goes for a 60-40 portfolio. 60% shares and 40% bonds for life. Right, really. That's an awful long time, June. June, who is loss averse, is starting the 60-40 not from retirement, but during her working life, right from the very beginning. That is conservative. This is Sandeep. Sandeep loves growth, but he's worried about losses in retirement. Oh, I see where this is going. So during his working life, he's going to go 100% the S&P 500, but as soon as he hits retirement, he's going the 60-40, 60% shares, 40% bonds. This is David. David loves growth. During the time he's working, he's going to go 100% Nasdaq-100. Aha, I see how that ties in with this video. And when he's retired, he's going to go 100% Nasdaq-100 as well. Wow, okay, that is brave. The question is, now that we have Sandeep, June and David with three totally different investment strategies, very conservative in the middle and then a supercharged racehorse, how are we going to compare to see which one actually wins in the end? Not so much only which one wins, but the ride along the way. Well, to do that, we need a market. We need to simulate the share market, including the 40% bonds and the 60% shares, or the 100% shares, depends on the portfolio, and I have the tool to do it. Firstly, we need to know the returns. I know the returns of the share market. Now let's have a look at the returns of bonds. Well, the historical returns for bonds is between 4 and 6% since 1926. I have created a market generator. It's something in a spreadsheet where the middle point is in fact the average return of the S&P 500, the average return of the Nasdaq-100 and the average return of bonds, which I just gave you that figure. Onto the average, which we know we're adding an element of randomness. For the Nasdaq-100, we're going to have a huge variation. We call that the standard deviation. For the S&P 500, it's going to be fairly large, but a little bit smaller. And for bonds, yeah, the standard deviation is going to be much, much lower. So we're tapping into what the true market is as far as the parameters and how it operates. This is a sample. The bonds returned 2% in this example. The S&P 500 had 12% and the Nasdaq delta, what's that mean? Well, the share markets are actually linked together. Obviously, they're pretty much the same share market. So as the S&P 500 goes up, the Nasdaq will tend to go up as well. So I'm using a random number generator within particular ranges. What would be odd is if the Nasdaq 100 returned 40% and the S&P 500 returned minus 40% all in the same year. Tends not to happen, so what I've done is I've chosen the randomness within S&P 500 and then I've chosen a delta which applies on top of the S&P 500. So naturally the Nasdaq moves up and down with the S&P 500, which it does in real life, and then it has a variation on top of that. It can go higher, it can go lower, and because of that it can actually produce a lot more fluctuation, a bigger standard deviation. Let's see how it works. So snapshot number 2. Oh, the bonds has returned 11%, S&P 500 returned minus 13, and the Nasdaq has returned minus 17. Aha, I see it underperformed the S&P 500. In snapshot number 3, bonds returned 1%, S&P 500 returned 11%, and the Nasdaq returned 16. Okay, well that's all looking good. So the market generator has averages which are truly set on the actual real market, and it's got standard deviations which are more or less in line with the real markets. There's some other things you need to know. built into my market generator. The stability of bonds is greater than the stability of the S&P 500, which is greater than the stability of the Nasdaq-100. Okay, well, that's true in real life. The returns, well, we know the Nasdaq is higher than the S&P 500, which is higher than bonds. Okay, so that's all correct. Now that we have our hypothetical market ready to go, we just need to know how our three portfolios are going to use it. So June, within her working life, she's going to go 60% S&P 500, 40% bonds. Once she's retired, she will basically be the same. Okay, lots of imagination there, June. With Sandeep, 100% S&P 500 when he's working. Once he's retired, no, he'll go 60-40. And David, when he's working, well, 100% Nasdaq 100, and he's going to keep it once he retired. Very good. The working life of these three people is going to be 40 years, and they're going to invest $10,000 a year every year without fail, and they're going to retire for 30 years, and that's how long the money needs to last. Good. Well, everything is laid in. Let's go. Let's start off with year number 1 with our simulated market and find out how they go. Everybody starts off with $10,000. Let's see how the market's gone. Well, 0% for bonds. S&P 500 is minus 16% and the Nasdaq is 7%. Aha! So clearly the Nasdaq wins on this occasion. So for June, we take the $10,000. We split it up. Remember, June is a 60-40 portfolio. 60% of our portfolio is affected by the S&P 500, which is minus 16%. The bonds, well, they are 0%, so no change there, which would take us to $9,360. And then, once that math is done, we add in $10,000 because they're adding in $10,000 a year. Sandeep has gone to $18,400 and David is $20,700. Yay, you're winning. So far it goes. Nasdaq 100 up the top, then bonds in the middle, and then the S&P 500 underneath. Is that likely? Sure. A single year, anything can happen. On to year number 2. What have we found? Well, bonds has again returned 0. What's going on with bonds? This is very interesting. But the S&P 500 is in lead with 30% return. The Nasdaq is 25. Okay. This gives June 31,000, Sandeep 33, and David 35. Aha! Although the Nasdaq underperformed the S&P 500 on this occasion, he is still out in front because of the previous year. On to year number 3. Bonds is minus 2. Wow, this is a very bad time for bonds. S&P 500 is 13%. Nasdaq is 9%. Once again, the S&P 500 is outperforming the Nasdaq. Does that actually happen in real life? Well, it can. Within a few short years, yes, it's happening right now. Remember, the S&P 500 is going along, and the Nasdaq is taking a huge dive. Is it only temporary? Well, most likely it is, but that's exactly what I'm seeing in my generated market. So with the 13% of the S&P 500, which affects both June and Sandeep, it affects Sandeep more because he's 100%. She goes to 42, Sandeep to 48, and David to 49, so he's edging out. In year 4, we find, Nasdaq 31%, bonds 11. Right, it's pretty good across the board, but very good for Nasdaq. June is 58. Right, so the bonds is now falling behind. Sandeep is on 65 and David is on 74. Wow, well done. Aha, we're starting to see a differentiation between the three portfolio types. Not surprising me. On to year 5, S&P 500 is in the lead at 38%. Nasdaq only 1% behind and bonds 4%. Yeah, okay. June is on 78, Sandeep has jumped up to 99, and David has jumped up to 111,000. Wow, you're doing so well. Okay, so let's summarize that using a chart. As you can see, everybody started exactly the same amount, $10,000. The Nasdaq 100 started off opening up fairly early and continued, and basically has been winning ever since. On to year 6. Bonds has won. Interesting. There's a crash in the market. No. Nasdaq is minus 35%. That's dismal. S&P 500 is minus 21%. So this is really incredibly realistic. June has gone up. You're the only person who's gone up. 78 to 85,000. Sandeep has crashed from 99 to 88, but because he was so far in advance, he's still in front of the 60-40 portfolio. But David, no, Nasdaq was doing so well, down to 82,000, which is behind bonds. So let's have a look at the graph of that. The yellow is Nasdaq 100, and it was beating everything, and then a huge crash, and now it's going below the 60-40 portfolio. Good. This proves that my market generator actually has the randomness of the true market. Shares are volatile. They do well overall, but in the short term they are volatile, and I'm proving that right now in the results we're getting. Over to year 7, 11% in bonds. Very good. Oh, minus 19 in the S&P 500 and minus 14 in the Nasdaq. Wow, okay, they're not done very well. Which means June is now in front with $94,000 and has beaten the other two people. Remember, June is the 60-40 and she's beating the straight shares. The 200% share portfolios are almost exactly the same, $81,000. Wow. And that's what we're seeing. The shares are doing particularly badly. The 60-40 is going fairly well. Over to year 8, we notice, bonds is minus 1%. S&P is 7%. Oh, Nasdaq is in front at 12%. Very good. But in year 8, the 60-40 portfolio is still in front at 106,000. How are the others doing? Well, Nasdaq is catching up at 100, but 97 for the S&P 500. Interesting. Over to year 9, 6% for bonds. S&P 500 comes out in front at 44. Nasdaq, not too bad, but 39. We now notice for the first time for quite some time, the S&P 500 has caught up 150,000, left behind in the dust the 60-40 portfolio, which has gone up 106 to 138. It's not bad, but it's nowhere near as good as 150. And, well, basically the Nasdaq is the same, both 150. Over to year 10, 5% bonds. Oh no, bad on the share market, minus 19 and minus 13. Wow. Which gives us the 60-40 portfolios in front again, isn't it? And the S&P 500 is last. Oh, let's have a look at the graph. This is almost comical. So the blue line is stable, going up and up and up, and the other two are zigzagging. Who knows whether they'll actually beat the blue line, but at the moment, no. They just seem to be going along for the ride. Right, let's push this into the next gear. I'm not going to show you the raw figures. You know exactly what I'm doing now. Let's just show the graphs. So year 11, the share markets have jumped up. The 60-40 portfolio in blue is doing fairly well, but the other two have now regained. Over to the 12-year mark. Oh, no, they've crashed. But the 60-40 portfolio has crashed as well, just nowhere near as bad. Up to year 14. Okay, we've jumped a couple of years. The Nasdaq-100 is put out in front. It's a clear winner. Second is the S&P 500, and the 60-40 is close in third. Over to year 16. We've jumped again. Aha! The Nasdaq-100 has jumped up. Oh, wow, you're breaking away, aren't you? S&P 500 is second and the bond fund is third. Over to year 21, jumping quite a few years here. Nasdaq is pulled away. S&P 500 is, well, it's a distant second. And the bond fund, although far more smooth and far more stable, is in fact lagging behind. Yeah, I can see that. Over to year 26, we find the Nasdaq is shot ahead and the other two have retained their position. Interesting, the 60-40 portfolio is almost seeing flat now. It's almost like a straight line. You can hardly see the variation in that line at all. Over to the year 31. Nasdaq still performing very well. Oh, S&P 500 has had a bit of a dip. Interesting. Which, of course, has affected the 60-40 portfolio because that is 60% S&P 500. Over to year 36. Nasdaq-100 has had a crash, but it's also recovered again. But no, it's not at its peak at the moment. S&P 500's come up, but you can see the huge gap that's now developing between the Nasdaq-100 and the S&P. And the bond fund, once again, very smooth, but it is lagging behind. And our final graph, remember, their working life was exactly 40 years. This is the 40-year graph, and this is how it's ended up. The Nasdaq-100 has recovered. Okay, we've caught it on a good upcycle. S&P 500 is actually off its peak somewhat. The 60-40 portfolio, well, it's almost just like a flat line down the bottom. That's it. We've completed the 40 years. The question is, how realistic is that? Does that look anything like the actual return of the S&P 500 versus the Nasdaq? Well, let's take a look. The answer is yes, it does. It's remarkably similar. Above is the real S&P 500 versus the Nasdaq. Below is my market simulation. It's random, okay, so there's going to be definitely differences. But we notice in both graphs, they travel along fairly closely together. And then about halfway along, the Nasdaq-100 tends to break away. And once it's broken away for good. It's quite varied. It goes up and down. Even the down years of the Nasdaq stay well above the S&P 500 because it's outgrown it by such a large amount. There we go, my market generator, which is based on the real parameters of the share market, but of course it is totally random, and what it did from year to year has turned out remarkably similar to the real markets, which is exactly what we wanted to see. Plus, we could experience of what a 60-40 portfolio feels like as you went through the 40 years, what an S&P 500 actually felt like, and what a Nasdaq felt like. Quite a ride. Remember, in the first few years, it was actually doing worse than the bond fund, the 60-40 portfolio, but then once it shot off for good because it's got a greater return. So you would assume over the long term you have to see that, and boy, did we see that. So our conclusions are the Nasdaq-100 has historically outperformed the S&P 500, and it did in our simulation as well. Although the Nasdaq-100 is more volatile, it eventually reaches the point where its dips are still far above the S&P 500. And we definitely saw that in our simulation. Number 3, adding bonds before retirement hurts your growth. This is something to keep in mind. You may want the smoothing effect of bonds. You certainly get it. We saw that in our simulation. Definitely a smoother ride. But the question is, are you prepared for the lower outcome, which invariably you will? We know this for a fact because bonds have a lower return. Now, in short periods of time, we saw in our simulations that the bond fund, the 60-40, actually outperformed the shares. Depends exactly when you took your snapshots, but we did see it. But of course, the longer you hold it, then the probability smooths out over time. We know the returns, they're there for a reason, and as you hold it, they become truer, they become more reliable. Short term, not so much. So, Sandeep, June and David started off with $10,000. Every year they put in a brand new $10,000 and the three of them invested in totally different ways. Today is the day of retirement. Let's see how much they've made. So June, with her 60-40 portfolio, has retired with $2,461,845. Well done, June. Sandeep, with his pure S&P 500 fund, has retired with $5.4 million. Okay, that's like double what June has. David, with his Nasdaq-100, happened to retire with $27 million. Oh, boy, that's a big jump up. Why such a big difference? 27, 5 million? That doesn't make sense. Well, what you're noticing is that these things compound over time. So with a difference of about 5%, of course that's 5% year after year, and that does compound. So the longer that you run the simulation, the bigger the gap is going to be. Also, it is a simulation. It is somewhat random. If we ran it again, we might find that the results are closer, but I expect them to be roughly the same as far as which one came in which order. Now we have the portfolio. Remember, 3 different portfolios, all retiring. We've hit the brick wall. What's going to happen? That, I'm running out of time, so I'll put that in my next video. Video number 2 will have the following. David is going to stay 100% Nasdaq, and boy, you're going to be in for a ride with that. Sandeep is going to remain in his 60-40 portfolio right throughout retirement. June is going to remain in her 60-40 portfolio, but remember, she's lost a lot of growth because she jumped into bonds very early. Take note of that. Not only are the assets that they're holding quite different, but also the way they're going to draw down is going to be different. I'm going to tap into the differences that you have, give you options, and that will be in the next video. So make sure you're subscribed so you don't miss out. While we're waiting for part 2 of the video, do you know that Australians have been tricked into superannuation? I know, I was shocked when I heard. Click here to find out more.